Have you ever seen a stock report amazing earnings, beat expectations, and then just tank? It's confusing, right? Well, that's exactly what happened to Broadcom, and the reason why is a masterclass in why you need to listen carefully, especially during earnings calls. Let's break down the drama. So, Broadcom comes out with their quarterly report. The numbers are fantastic. They crushed it. Revenue is up. Profits are solid, and their forecast for the next quarter is even better than what Wall Street analysts were hoping for. Everything is pointing up. The stock initially pops in after-hours trading, just as you'd expect. Investors are happy. The future looks bright. But then the conference call starts. This is where things get interesting. The CEO Hock Tan and his team get on the line to talk about the results and answer questions from analysts. They're highlighting their successes, talking about strong demand in their semiconductor and software businesses. It's all good news. Then the Q&A session begins. An analyst from Bernstein asks a pretty important question. He wants to know about the company's backlog, basically, the pile of orders they have that they haven't fulfilled yet. A huge backlog is usually a great sign. It means business is booming and future revenue is locked in. The analyst asks if their massive $100 billion software backlog is growing. Now, here's the critical moment. Hock Tan responds, and his answer is what sent the stock spiraling down. He says something along the lines of, "We're not really focused on building that backlog anymore." Whoa, wait a minute. To an investor just half listening, that sounds terrible. It sounds like they're saying, "We don't care about getting new orders." The market's reaction was immediate and brutal. The stock, which had been up, reversed course and dropped sharply. People started selling, thinking the good times were over. But here's the twist. They completely misunderstood what he was saying. Hock Tan wasn't saying they didn't want new business. He was making a much more nuanced point. Let's dig into what he actually meant. For years, especially during the pandemic and the supply chain chaos, companies were building up huge backlogs. Customers were panic ordering, trying to secure parts and software for years in advance because they were scared of shortages. This created massive, sometimes artificially inflated backlogs. Broadcom was a master at this, locking in customers with long-term, non-cancelable contracts. This gave them incredible visibility into their future revenue, and Wall Street loved it. What Hock Tan was trying to communicate was a shift in strategy. The world has changed. The supply chain crisis is largely over. Things are getting back to normal. So, focusing on just growing a giant backlog isn't the main goal anymore. Instead, he explained that their focus is now on execution. It's about delivering the products and services that are already in that massive backlog and converting those orders into actual revenue. He even said their backlog for semiconductors, which are physical chips, is still over $50 billion. That's a huge number that guarantees revenue for a long time to come. He was essentially saying, Look, we've already secured the future. We have years' worth of business locked in. Now, our job is to deliver on those promises and manage the business efficiently. It's a pivot from a wartime footing where you hoard resources to a peacetime footing where you build and deploy. Think of it like a restaurant. During a rush, the main goal is to take as many orders as possible. But once you have a mountain of order tickets, the focus shifts to the kitchen, actually cooking the food and getting it out to the tables. You're not going to stop taking new orders, but your main priority becomes fulfilling the ones you already have. The market, in its knee-jerk reaction, only heard the first part. We're not focused on building the backlog. They missed the crucial context. They missed the part where he talked about the strength of their existing orders and the shift towards execution. This is a classic case of the market hearing what it wants to hear, or in this case, hearing what it fears. The algorithms and high-speed traders likely picked up on the negative-sounding keywords and sold off automatically, before any human could sit back and say, wait, what did he really mean by that? This situation highlights a few key things for any investor. First, earnings reports are more than just the numbers on the page. The commentary from management on the conference call is where you find the real gold. It provides the story, the context, and the strategy behind the numbers. Second, you have to listen to the entire conversation. Pulling one quote out of context can give you a completely wrong picture of the company's health and direction. It's like reading one sentence of a book and thinking you know the whole plot. And third, it shows how sentiment and interpretation can temporarily overwhelm solid fundamentals. Broadcom's business did suddenly become worse in the 5 minutes it took the CEO to answer that question? In the case of Broadcom, the company reported a stellar quarter, gave strong guidance, and has a fortress-like backlog. The business is doing great. The stock just had a little panic attack because the market wasn't listening closely enough. But what do you think? Have you ever seen a stock react strangely to good news? Let me know your thoughts in the comments below. It's always fascinating to see how market psychology plays out in real time. Thanks so much for watching. And if you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the stories moving the market. See you in the next video.